Well, we've got another positive inflation print this morning. The producer price index rising less than expected, up 0.1% from May, while the street expected a 0.2% pop. This, of course, after CPI came in at its lowest level since March of 2021. So does this pricing data put a damper on the Fed's hiking plans? Jill Malandrino, Nasdaq Global Markets reporter, is here to weigh in on all of this. So, Jill, what are your thoughts on this inflation print?
Well, it's certainly the latest sign that inflation is calming in the United States, bolstering the case for the Fed to step back from its aggressive policy tightening campaign after an expected interest rate hike next week. This follows on Wednesday's CPI data coming in lower than expected. The macro team at LPL Financial expects the Fed to not only end its rate hiking campaign toward the end of 2023 as inflation abates, but also introduce the possibility of a rate decrease. A cut in rates in a recession could happen should consumer demand and job growth cool and unemployment rise, as all three are expected to do. LPL believes if inflation convincingly cools, markets will likely respond favorably to the Fed lowering rates. So far, an improving Chinese economy hasn't materially impacted global inflation, which is a good sign as well. It is important to note, however, that backward-looking data has tended to surprise to the upside, while more of the forward-looking or survey-based data has told the opposite story. The Fed's inflation target is 2%, and it is nowhere near that. Core is still at 4.8%. The CME FedWatch tool, which analyzes the probabilities of changes in the Fed rate, shows that there's still a strong likelihood that a hike will take place during the July meeting. Fed Chair Jay Powell's press conference following a rate hike announcement will be highly scrutinized as investors will try to discern if his comments remain hawkish.
Now, Joe, we also got new jobs data this morning as well. Jobless claims shrank with 237,000 initial claims found. What do you think about this jobs data and what it says about the health of the economy?
Well, let's go back to the non-farm payrolls report for June that we saw last Friday, because that really is the key piece of data. We saw an increase of 209,000 jobs in June, but persistently strong wage growth pointed to a still tight labor market. And the Fed watches wage data because it worries that if pay growth remains unusually rapid, it could make it difficult to bring elevated inflation fully back to their 2% goal. This data showed the 30th consecutive month of gains in American payrolls, but the June figure represented a continued cooling of the labor market, which will be factored in the Fed's interest rate policy. Now, June is typically the strongest month for jobs growth due to seasonality, which students and teachers off for the summer looking for seasonal employment. So if June, which is strong, showed a slowdown in jobs, it could indicate a downward trend is forming. 1 month is not a trend make, so we'll have to see how that plays out. Now, slowing inflation and labor market demand easing is positively received by the market because it's perceived that the Fed will adopt a less hawkish stance. The key as it relates to job, though, we have to get the wage growth to come in.
Well, let's look ahead. What do you think we can expect from the remainder of the second half of the year, given how strong the first half of 2023 has been so far?
Well, the narrative for the first half of 2023 was simple. Results were better than expected. The labor market was strong, consumers and businesses stayed confident, and the economy grew despite challenges in the banking sector, which had the potential to derail this progress. All market indices were up, corporate earnings beat expectations, and while growth slowed, financial conditions remained steady and inflation is dialing back. Now, for the remainder of the second half, we have to acknowledge many of the risks that existed at the start of the year, including the possibility of a recession that is yet to materialize. They still exist. Brian Price, head of investment management for Commonwealth Financial Network, said when you cut through the noise, there is positive data. Economic growth looks poised to continue. Market tailwinds, particularly earnings growth and potentially lower inflation and rates, they're blowing. Those tailwinds are there. Brian believes that growth will almost surely be slower, but that slower growth could mean lower rates, which of course will help support the markets.